Realization concept. According to this concept, any change in the value of assets is to be recorded only when the business realizes it. Why this is so? Because normally the assets are recorded at historical value. So what we have already discussed about historical concept, okay, that is cost concept, very clearly says that only at the price at which an asset is acquired is normally recorded every year. So when will a change actually be incorporated, or when will the asset show a change? So that is what this realization concept is all about. So such an asset which was recorded, okay, in the past throughout at its historical value, when it would take a different value, means when this asset gets sold out, okay, and there is a sales proceeds. That is what we mean by business realizing it, okay. So only that is only when the business, that means only when in the business asset is sold can you actually consider it at the change or the new value. Otherwise, if the business is going to retain the asset, okay, in the for the future, even in the near future, when it is going to continue having this asset, in that case it will actually continue only with the historical value. That means the price at which it was acquired, and no changes that is taking place will be recorded, okay. So this is what the realization concept explains about. Next, objective evidence concept. So what do you mean by this evidence? Normally the word evidence refers to keeping some supporting source documents. So any transaction will normally be supported by source documents. So that means there should be an evidence or a proof supporting a transaction. So what could be those documents or evidences? Normally documentary evidences may include, okay, certain transactions like receipts, invoices, okay. When you say receipts, it may be cash receipts also, and certain pay-in slips. When any bank transactions are actually made, pay-in slips also will serve to be an documentary evidence. So this objective evidence says that when these documentary evidences are given, there will be providing authenticity, accuracy and reliability. What do you mean by the word authenticity? It means being very genuine or real. On the other hand, accuracy refers to just having some correctness or in confirmation or in conformity to a particular standard, or we can say in simple terms there is some exactness, okay. That is the word accuracy. The term reliability means it talks about being trustworthy or something that we can depend on, which is dependability. So objective evidence concept very clearly states that there should be actually a documentary evidence in support of a transaction. Accrual concept. The word accrual means as it when it arises or takes place, and moreover transactions are recorded on mercantile basis. Here it is to be noted that revenues that will be earned or incomes which will be earned are recorded in the books of accounts only when it is earned. What do you mean by earned? That means when we actually receive it and we could see that physically. But it says that normally here under accrual concept, even when it is, okay, earned, irrespective of the fact it is received or accrued. So you are yet to receive it. You have earned but you are yet to receive, but still we will be showing as per the accrual concepts. So accrual concepts very clearly states in par with revenues or income that will actually be earned, or it will be in case if it is received or even not received and yet to be earned. These revenues, okay, usually it will be received in cash. Even though if it was not received in cash and it is intended for a future period, that also will be coming under accrual concept. On the other hand, if there are expenses which are supposed to be payable, okay, expenses which are to be met, and these expenses whether it has been paid in cash or yet to be payable, so that's what it says, not cash, not paid, not met in cash means it is yet to be paid, intended for a future period. So current transaction, okay, is taking place, but payment is not yet done in par with that. So this also is what we mean by accrual concept. So both revenues received in cash or not, as well as expenses paid in cash or not. To talk about examples for this, we can mention about credit sales. Normally, what is the meaning of credit sales? Sale has been taking place at present, but the amount for that particular transaction will be met only in the future. Okay, so that means you are not receiving cash immediately. So as per accrual concept, so though cash was not received, but still we treat it as a transaction and we will record. Another example we can take in respect of rent, which is to be payable for the month of March, has to be actually payable. But we see a situation that in this case, rent will be payable only in the month of April. And if the accounting period follows the year from April to March, so it is very obvious that rent, even though it was for the month of March, will be payable in April. But when we say April, so it denotes that a new financial year begins, and with the month of March the actual financial year ends, and from April onwards, 1st April onwards, the new financial, that is accounting year, will begin. And you can see that though it is a new accounting year, and there will be this rent amount shown in this year. So but though we say it is actually the rent for last year, it will be actually considered as though it is still outstanding. So when the previous year, that up to March, when the year ends and the rent is actually considered, it will be actually as though rent is not yet paid. So not yet paid means what? It has become due and still outstanding. So this outstanding actually will have to be shown in the actual year itself, and not to be taken to the next new accounting year. So accrual concept also will be applicable in these cases of rent payable. Next will be convention of consistency. So this principle very clearly states that accounting policies, procedures, methods, practices, all these have to be followed in a uniform manner. So that means from one accounting period to next accounting, to the next accounting period, it will be helpful, only then for one to make some kind of comparisons. So if you want to arrive at some kind of maybe you want to make analysis and interpretations, then you go for comparisons. So such comparisons will be helpful only when there ensures uniformity. So example, let me tell you about the methods of providing depreciation. So for what do we normally provide depreciation? For fixed assets. Fixed assets, like it could be a land or a building or some kind of a furniture. When the depreciation is done, it is done since its acquisition. From the date it was purchased, the principle of depreciation will start working on that asset, and gradually it will be reducing its value. So what is the method that the business actually caters to? What is it going to observe as a method of charging depreciation is all about? So it should not be a straight line method in the previous year, and then just switching over to a written down or a diminishing balance method, or an annuity methods. So that various methods actually for providing depreciation of fixed assets. So whatever be the method, it should be very consistent. Consistency means, as I told you, uniform. It should not keep changing the methods. If it changes, then your comparison may not be that effective. But again, where can possibility of changes actually be implied? So can possibility be implied? Yes, of course. There is some exceptions. Number one, when there is going to be a change in the law, provision of law, maybe the previous law has brought in some changes, and there has been a new amendments of laws. That cases will your actual this change in the consistency may be applied, and also with the accounting standards. Okay, what do you mean by this provision of law? So there's a meaning that you could see. The word provision of law means that we have to actually act in agreement or uh, for a law. Okay, why this agreement should take place? Because there should be certain thing to happen or take place, or it need to be performed. So if something has to be performed, then there should be a law actually enforced in order to enable something to take place. And as you say, okay, in also to help one to know the uh, okay, accounting standards issued. So what do you mean by accounting standards? So what will be the actual okay, standards that has been given currently, and those standards have to be actually followed, that has been issued by the accounting boards and so on. And then finally it also changes can be in case, okay, to reflect a true and fair state of view of a state of affairs of the business. What do you mean by state of affairs? That means business affairs. So business affairs, when we talk about, it refers to various aspects that are present in the business, which could be assets that have been acquired by the business, or liabilities, okay, that have arose, okay, that keep arising, okay, as and when it happens. Liabilities, for instance, it could be the sundry creditors, or it could be bank overdraft, or it could be some kind of loans, etc. These all will constitute liabilities. And the financial condition of the business. What do you mean by financial condition? So how far are the money matters, we can say in simple terms, money matters of the business, okay, are they good or sound, etc. Next is about the prospects. What do you mean by the word prospects? Okay, the chance of growth in the future. And then finally the results of the operation. So whatever the business is actually carrying out, whether it is able to get a very good income, okay, in view of its profits and losses. There should be no losses, so it's a positive sign. In short, we can say all activities, matters, or events or proceedings, okay, or undertakings, concerns can actually take the meaning of affairs. So here we can see that as per the convention of consistency concept, there should be uniformity. It normally ensures uniformity, and it's very important.